The S&P 500 is a stock index that is constituted of around 500 of the leading publicly traded and consistently profitable U.S. companies with large market caps and high liquidity. The S&P 500 constituents are selected to represent every major industry, from information technology and healthcare to financials and consumer staples, in order to reap the benefits of diversification. Therefore, because of its depth and diversification, the S&P 500 is generally regarded a good proxy for the overall health and performance of the U.S. stock market and economy. Investing in the S&P 500 funds and ETFs is an excellent way to get exposure to some of the best performing and reliable stocks, such as the Magnificent Seven and industry-leading blue-chip stocks, whilst reducing risk through diversification. This makes the S&P 500 highly favored by investors due to its relatively high and consistent annual returns. Since its inception in 1957, the S&P 500 has approximately averaged 10% annualized returns. Therefore, over the longer term, the S&P 500 generates higher return on investments than most investment funds, such as hedge funds and mutual funds.
You can't beat the market. It doesn't work, especially when you deduct all the fees, the commissions, and also the taxes from short-term trading. So let's say a hedge fund returns 15% 1 year. Say, well, that's pretty good, right? But after they take their 2% management fee, 20% performance bonus, right? Suddenly it's not even beating the S&P 500, and that's in a good year. Most of the time they don't even beat it without their fees.
So why would anyone hand money to a hedge fund?
So Warren Buffett asked this exact question back in 2007, made a big announcement, bet $1 million that I don't care whatever hedge fund you are, you can't beat the S&P 500 over 10 years. And at first, no one took the bet. Eventually, someone did with what's called a fund of funds. It was 100 different funds, right? And after year 7, they threw in the towel. They couldn't even come close to the S&P, and that was without all their fees.
You can't directly invest in the S&P 500 because it's an index, but you can invest in shares of index funds and ETFs that track the S&P 500 index by holding the same equity constituents and compositions. Some examples of these assets include the SPDR S&P 500 ETF Trust, Vanguard S&P 500 ETF, and iShares Core S&P 500 ETF.
I think it's the same thing that makes most sense practically all of the time, and that is to consistently buy an S&P 500 low-cost index fund. Keep buying it through thick and thin, and especially through thin, because the temptation gets, when you see bad headlines in newspapers, maybe to say, well, maybe I should skip a year or something. Just keep buying it. American business is going to do fine over time. So you know the investment universe is going to do very well. The Dow Jones Industrial Average went from 66 to 11,497 in 1 century. And then since that century has ended, it's more or less doubled again. American business is going to do well. The trick is not to pick the right company. It's to be, because most people aren't equipped to do that, and plenty of times I make mistakes on that. The trick is to essentially buy all the big companies through the S&P 500, and to do it consistently, and to do it in a very, very low-cost way, because costs really matter in investments.